Good morning. I'm Tracy Gordon, Acting Director of the Urban-Brookings Tax Policy Center. Welcome to International Corporate Tax Reform, BEPS, and Biden. Over the weekend, finance ministers representing the Group of 20 large economies approved a plan for taxing multinational companies. This is an important step toward addressing a decades-long race to the bottom, as countries have competed not only to attract investment from multinational corporations through lower tax rates, but also to help resident multinationals compete by allowing them to shift profits to very low tax countries. The plan includes a global minimum tax rate of 15%, as well as a mechanism to allow countries to tax large profitable companies where they sell goods and services, rather than just based on their headquarters or intellectual property locations. The OECD shepherded the plan, and 130 countries have embraced it. But some businesses in low tax countries remain skeptical. Questions also remain about the ability of President Biden to persuade a deeply divided Congress to go along with the changes. To help us unpack all of these questions, we're extremely fortunate to have Grace Perez-Navarro, Deputy Director of the OECD Center for Tax Policy and Administration. I'll provide more background on Ms. Perez-Navarro in a moment, but first, some housekeeping. This event is being recorded and will be posted online afterwards. Speaker biographies are available online at urban.org. We have live captions turned on for this event. You can hide them or adjust your settings with the live transcript live transcript button at the bottom of your screen. All participants are muted, but you can send questions or comments in the Q&A box at any time. And feel free to tweet about this event using the hashtag #live@urban. Ms. Perez-Navarro plays a key role in all of the OECD's tax work, including addressing the challenges of digitalization, the base erosion and profit shifting, or BEPS project, improving international tax cooperation, tackling illicit financial flows, promoting better tax policies, and engaging developing countries in OECD tax work. Since joining the OECD in 1997, she has held several key positions, including leading the OECD's tax work on bank secrecy, e-commerce, harmful tax practices, money laundering, countering bribery, and strengthening all forms of tax cooperation. Prior to joining the OECD, she was special counsel at the IRS Office of Associate Chief Counsel International, where she coordinated guidance on international tax issues, oversaw litigation of international tax issues, negotiated treaties, and reviewed regulations, rulings, and other policy advice. In 1993, she was seconded to OECD to launch revision of OECD's transfer pricing guidelines. Ms. Perez-Navarro will be speaking for about 20 minutes, followed by 10 minutes of Q&A. And please don't forget to submit your questions in the Q&A feature. Welcome, Grace.
Thank you, Tracy. It's really a pleasure to be here, even if only virtually, to talk about the recent developments in international tax reform. You will surely have seen that earlier this month, it's now 132 countries and jurisdictions. We've had 2 additional joiners since July 1st, all members of the OECD G20 Inclusive Framework on BEPS, and representing more than 90% of global GDP, have joined an historic statement establishing a new 2-pillar framework for international tax reform. This major achievement has been a long time coming. The international tax rules are 100 years old and no longer work in the context of today's globalized and digitalized world. The 2-pillar package agreed this month seeks to address 2 key problems. First, multinational enterprises are only obliged to pay corporate income tax in foreign markets where they have a physical presence. 100 years ago, when business activities revolved around factories, warehouses, and physical goods, this made perfect sense. But in today's digitalized world, M&Es often conduct large-scale business in a jurisdiction with little or no physical presence there. The second problem is that the M&Es are able to shift their profits to low tax jurisdictions and avoid paying tax in their residence country. This is a long-standing issue and is why we initiated the BEPS project in the first place back in 2013. The OECD estimates that corporate tax avoidance costs anywhere from $100 to $240 billion annually, or from 4 to 10% of global corporate income tax revenue. And while the BEPS package of 15 measures agreed in 2015 go a long way towards addressing these issues, the package was incomplete. And so the statement issued on July 1st provides a 2-pillar solution to these problems. Pillar one, as you've already mentioned, would bring dated international tax rules into the 21st century by giving market jurisdictions new taxing rights over the largest and most profitable M&Es, those with a global turnover of above 20 billion euros and profitability above 10%, whether or not there is a physical presence of the business in a country. This is a major departure from the existing permanent establishment rules and the arm's length principle, in that a formulaic approach is used to allocate a portion of the profits, 20 to 30% of the M&E as a whole. This new taxing right for market jurisdictions amounts to new taxing rights over approximately 100 billion US dollars. The turnover threshold is to be reduced to 10 billion euros after 7 years, contingent on a successful implementation of Amount A, so that we can look at all of this very carefully after review, ensuring that there has been effective implementation, and that review would be completed in 1 year. Extractives and regulated financial services are excluded from the scope of Amount A. Now, in terms of Nexus, there will be a new special purpose Nexus rule permitting allocation of Amount A to a market jurisdiction when the in-scope multinational derives at least 1 million euros of revenue from that jurisdiction. Now, for smaller jurisdictions with GDP of less than 40 billion euros, the Nexus will be just 250,000 euros. This was designed to ensure that developing countries benefit from Amount A, but at the same time, we limit the compliance costs for M&Es that would result if we had no threshold at all, and they would then have to try to allocate very small amounts across different jurisdictions. It is important to keep in mind that the special purpose Nexus rule applies solely to determine whether a jurisdiction qualifies for the Amount A allocation and not for any other purpose. The compliance costs, including on tracing the small amounts of sales, will be limited to a minimum, and this is part of the further work that we will have to do. Tax certainty is a key component of this deal. In-scope M&Es will benefit from new dispute prevention and resolution mechanisms, which will avoid double taxation for Amount A, including all issues related to Amount A. So, for example, the transfer pricing and business profit disputes in a mandatory and binding manner. This also is very innovative. A lot of the new dispute prevention and resolution mechanisms were already described in the blueprint that we issued in October. Consideration will be given to an effective binding dispute resolution mechanism for issues related to Amount A for developing economies that are eligible for deferral of their BEPS Action 14 peer review and have no or low levels of MAP disputes. This is an attempt to try and address the concerns of countries that have very limited resources and limited disputes from having to implement the procedures. In Pillar 1, we also provide for the standstill and withdrawal of unilateral measures, such as digital services taxes, so that we can restore the stability to the international tax system and avoid trade disputes over such measures. Pillar 2 provides for a minimum tax on corporate profits of at least 15%, which puts a floor on tax competition. Governments worldwide would agree to allow additional taxes on the foreign profits of multinationals headquartered in their jurisdiction up to an agreed minimum rate. This is a major new tool that countries can use to protect their tax bases. These rules will apply to multinationals with a 750 million euro turnover, so basically the threshold that we use for country by country reporting, with exclusions for certain entities like government entities and pension or investment funds. This would mean that competition for foreign investments via tax holidays and other tax breaks would now be backstopped by a minimum level of taxation wherever an M&E operates. This will include a substance-based carve-out where companies carry on real activities. Now, Pillar 2 consists of two interlocking domestic rules, together referred to as the Global Anti-Base Erosion Rules, or GLOBE. First, we have the Income Inclusion Rule, which imposes top-up tax on a parent entity in respect of the low taxed income of a constituent entity, and to an undertax payment rule, which denies deductions or requires an equivalent adjustment to the extent the low tax income of a constituent entity is not subject to tax under an income inclusion rule. And there is also a treaty-based rule known as the subject to tax rule that allows source jurisdictions to impose limited source taxation on certain related party payments subject to tax below a minimum rate that still is to be agreed. Now, the subject to tax rule will be creditable as a covered tax under the GLOBE rules. The subject to tax rule is an integral part of achieving a consensus on Pillar 2 for developing countries. The inclusive framework members that apply nominal corporate income tax rates below the subject to tax rule minimum rate to interest, royalty, and a defined set of other payments have agreed to incorporate the subject to tax rule in their bilateral tax treaties with developing countries that are IF members when they are requested to do so. The taxing right will be limited to the difference between the minimum rate and the tax rate on the payment. The minimum rate for the subject to tax rule will be from 7.5% to 9%. Now, the GLOBE rules will have the status of what is known in the BEPS world as a common approach. This means that inclusive framework members are not required to adopt the GLOBE rules, but if they choose to do so, they will implement and administer the rules in a way that is consistent with the outcomes provided for under Pillar 2, including in light of the model rules and guidance that we are developing and will be agreed to by the inclusive framework in the future. And also, they accept that the application of the GLOBE rules as applied by other inclusive framework members, including agreement as to the rule order and the application of any agreed safe harbors, is acceptable. And so that's quite important. Now, one of the questions, obviously, in the US and elsewhere is, what about GILTI? So the agreed approach says that the Pillar 2 will apply a minimum rate on a jurisdictional basis. And we know that the current GILTI rules do not apply on a jurisdictional basis, but rather on a global basis. So it's in this context that there is agreement that consideration will be given to the conditions under which the US GILTI regime will coexist with the GLOBE rules to ensure a level playing field. And this obviously signals that we need to see what changes may come about to the GILTI rules going forward. The Pillar 2 does not eliminate tax competition, nor should it, but it does set multilaterally agreed limitations on it. The Pillar 2 is expected to generate more than 150 billion US dollars in new tax revenues globally and put an end to the use of tax havens for profit shifting. So this is why this package, which I haven't described in all the detail, is so important and groundbreaking. Now, there was quite a lot of political impetus for this change, and I don't think otherwise this would have happened. The OECD has, as you know, been working on the issues of tax avoidance and tax evasion for decades, but was not really able to make significant progress without strong political impetus. We saw this very clearly in the wake of the 2008 financial crisis when the G20 got behind our efforts to end bank secrecy and strengthen cross-border information flows between tax authorities. And the financial crisis also helped put the political spotlight on tax avoidance by multinationals, which propelled the BEPS project forward. As I said before, the BEPS project has been successful, but was incomplete. We did not really address the concerns that led to making the digital economy Action 1 of the BEPS package. The agreement in 2015 was to see how the other BEPS measures dealt with the issues of concern in Action 1 and to return to the issue in 2020. So we basically just kicked the ball down the road. This approach reflected the lack of consensus on dealing with the fundamental issues that were of concern to so many countries around the world, namely the ability of large multinationals to engage very substantially in the economic life of another jurisdiction, but without the physical presence required for that jurisdiction to be able to tax the profits derived from its territory. This lack of a multilaterally agreed solution is what opened the door for unilateral digital levies and other similar taxes, which ultimately led the USTR to threaten trade sanctions. So the work on Action 1 was relaunched in 2017 in response to a G20 request, and the US tax reform at that time helped to reopen the discussions. Pillar 2 was clearly inspired by the GILTI and would never have been proposed had the GILTI not already been in place. As everyone knows, the negotiations stalled on Pillar 1 with the Trump administration's proposal to make Pillar 1 a safe harbor that companies could opt into if they wanted to. The Biden-Harris administration moved very quickly to propose changes that would help produce a solution that could restore multilateralism to the international tax world, and that would be acceptable at home. It has also made this a top political priority in discussions with foreign counterparts, which has greatly helped to secure this landmark agreement. So now I know everyone's wondering, what are the next steps? Well, we're going to have a very busy summer. You will have seen that the G20 Finance Ministers have called on the Inclusive Framework to swiftly address the remaining issues and finalize the design elements within the agreed framework, together with a detailed plan for the implementation of the 2 pillars by their next meeting in October. So what does this mean in practice? Well, the 2-pillar solution has a number of points on which Inclusive Framework members must still agree the details. So for example, the statement currently says that the amount of profit to be reallocated under Pillar 1 will be between 20% and 30%. And the global minimum tax rate under Pillar 2 will be at least 15%. The subject to tax rule says that the minimum rate will be between 7.5% and 9%. More precise numbers need to be decided between now and October on these issues. So these and other elements, such as the defined payments under the subject to tax rule, will need to be finalized by October, along with an implementation plan that would include the development of model legislation to facilitate implementation of the measures in a consistent manner, and guidance on the application of the different measures, development of a multilateral treaty in 2022, and implementation beginning in 2023. So you can see that there's a lot of work ahead, but nevertheless, we now have a solid foundation with a very substantial agreement on which to build. Thank you.
Thanks very much. We have a lot of questions, as you can imagine, about the holdout problem. So for the inclusive framework, there were a number of countries that did not sign the agreement. Could you address what you think the issues might be for those countries and how they would be addressed?
Yeah, sure. Well, first of all, I would say there's a very limited number of countries that did not sign on to the agreement at this time. We have 139 members of the Inclusive Framework and 132 have signed on. I think for some, there was insufficient time for them to assess the various provisions. And for others, they wanted to wait and see what the final outcome of the package is. For some, and I think it's been no secret, for a country like Ireland, the rate of Pillar 2 is very important. And so at the moment, what we have is a statement of a rate of at least 15%. Well, some countries have expressed concern that, well, they might be okay with 15%, but they may be less okay with the higher rate. So I think countries want to see what the whole package looks like before they make a commitment. I think it is important to highlight that all of the countries, the 7 countries that have so far not signed on to the statement, have indicated that they intend to continue to work constructively through the inclusive framework, through this next phase of the project. And so we will expect that by the end, they will be joining as well.
Then there's obvious trade-offs with complexity, and there was a question about the 10% profitability scope and how that made it through the negotiations, and if you'd consider perhaps dropping that to make things easier to administer.
I don't really know that changing the 10% will make it easier to administer. The 10% is a negotiated agreement. And so I don't think that is going to change. The simplifications may come elsewhere in the actual implementation, but I don't think it will come in changing the 10%.
There's also a question about what is the base for the global minimum tax? Is it global corporate book income? Is it taxable income as defined by legislation? And if so, whose accounting standards or whose legislation?
We are relying on financial statements with certain adjustments. And I think a lot of that is explained in the blueprint on Pillar 2 that we issued in October. We decided to use financial statements rather than the income tax rules, because what we needed was information that was accessible to all countries, developing countries as well. So we are using financial accounting and with certain adjustments.
And would there be potentially certain carve-outs? There was a question in the chat about India in particular having a higher threshold under Pillar 1. Would you think that perhaps incentives to get certain countries on board might be considered?
India has joined the statement.
Sorry, it was, I guess, it's just about treating different countries differently. So whether they're on board or not, there will be cases made for different profitability thresholds or perhaps differences in the global minimum tax.
No, part of the reason for setting a common standard was to simplify administration, both for tax administrations and also for taxpayers. We have set the rate of at least 15%, and that will ultimately be clarified as to what the precise rate is. We've also said that for countries can choose to have a lower threshold for their own companies in terms of including them. For Pillar 2, we have the CBCR threshold of 750 million euros.
And how will transfer pricing fit into all of this?
Well, we have not abandoned the transfer pricing rules completely, but for Amount A, we have set those aside, and instead we have adopted a formulaic approach. So in that sense, we have moved away from the arm's length principle for those companies in scope for the application of the Amount A. Now, this is part of the reason why we need to include in the tax certainty process not only tax certainty with respect to amount A, but also with respect to related transfer pricing and other disputes, because this new system is in effect an overlay on the transfer pricing rules, because amount A applies to a % of the residual profits.
And you mentioned the GILTI as being an important precedent. Are there reforms that'll be needed for the US's global minimum tax to make it compatible with Pillar 2?
Well, I think that is one of the things that the Biden administration is contemplating to reform the GILTI. One of the proposals is to move it to a jurisdictional basis rather than a global basis. We haven't yet seen legislative proposals, but I think the idea is to get closer to the Pillar 2 approach.
Let's see, I'm just looking through all the questions I've been writing down. I guess one question is whether the legislation as it goes through Congress is probably not your area, but is this considered something like a treaty that would require 2/3, or is this more like simple tax legislation that would require only a simple majority? And I guess that leads into the question of sort of what if the US does not go along with what's next for OECD?
Yeah, well, I think there will be some normal legislative changes required, and then we are planning to develop a multilateral treaty for the implementation of amount A. Okay. And so that would require approval as in the same way as any treaty would.
And is it anticipated that the agreed technical details for both pillars will be publicly released in October?
What we are planning to release in October is the final agreement and the implementation plan. Obviously, we won't have the multilateral treaty ready for release then, but we will have a very detailed implementation plan setting out the timeline for finalization of the remaining elements. And as we have said in the statement, we expect implementation to begin in 2023.
And we're getting more questions about the holdout issue. So since even inclusive framework members who did sign the agreement are not required to implement Pillar 2, how many people or how many countries do you think will actually implement Pillar 2?
I think there will be a lot of countries that will be implementing Pillar 2, given the strong interest in its development and the fact that it helps countries protect their tax bases. Now, we have within the inclusive framework a number of no or low tax jurisdictions, and I don't know that they're going to be implementing Pillar 2, but the beauty of Pillar 2 is that you don't need every country in the world to implement it, because it is a measure that a country can implement to protect its own tax base, irrespective of what other countries do. And so it doesn't matter if a zero tax jurisdiction doesn't implement it. The Pillar 2 provisions will allow the residence country to tax back essentially the income that has not been taxed in the zero or low tax jurisdiction.
And is it possible that the 10% test is an interim step toward formulary apportionment of total worldwide profits?
I don't know at this stage. I sort of doubt it at this point, given the negotiations we've had, but I think there has been a recognition that we have a situation where this is the only viable way of dealing with this issue. And so this will obviously be a test of whether a formulary approach can be used more widely. I think this is part of the reason that we're starting with a limited number of very large companies to make sure that this system will work effectively. And then we are reassessing in 7 years.
Terrific. I think we are out of time. I want to thank you so much for joining us and illuminating these issues. I'm sorry that we couldn't get to all the questions in the chat. but we'll move on to the panel that can probably cover many of these issues. So thanks again.
Thank you.
So next I'm going to introduce Thornton Matheson. Thornton Matheson. Thornton is a senior fellow at the Urban-Brookings Tax Policy Center. Her work focuses on business and environmental tax policy. She previously held positions as a senior economist in the tax policy division of the IMF's Fiscal Affairs Department, and as a financial economist for the U.S. Treasury's Department of Office of Tax Analysis. So Thornton, I'll bring you on.
Thank you very much, Tracy.
Thank you.
And thank you so much to Grace for the keynote address. Wonderful to hear from you. I'd like to introduce now our panelists. We have with us today Lillian Faulhaber, who is a professor at Georgetown University Law Center. Lee Liu, a senior economist in the International Monetary Fund's Fiscal Affairs Department. And Andrew Lyon, principal at PricewaterhouseCoopers and formerly of the former Deputy Assistant Secretary at the Treasury Department. Welcome to all our panelists. I look very much forward to hearing from you on BEPS and its US implications. Just briefly at the outset, I'm going to give an overview defining some terminology that you may wish to then use for conciseness in making your points. So as Tracy was commenting, since the 1980s, there has been a clear downward trend or race to the bottom in global corporate income tax rates as countries compete to attract investment from multinational corporations. This has made it more difficult for some countries, particularly developing countries, to raise revenue. Lower corporate tax rates have been accompanied by a trend towards exemption of multinational corporations' foreign earnings, so-called territoriality. Whereas many developed countries once levied worldwide residence-based taxes on the foreign earnings of resident corporations, today the only OECD country with a significant tax on foreign earnings is the United States, with the global intangible low income or GILTI tax regime. In contrast to previous worldwide regimes, however, GILTI taxes active foreign earnings immediately, creating deferral of foreign earnings taxation until dividend repatriation. And GILTI, as Grace was commenting, has become the model for BEPS Pillar 2. The spread of territoriality means that most corporations are currently taxed on their earnings only in the host or source countries where those earnings are generated. However, with the rise of the digital economy and global intangibles, it's been getting harder to locate the source of corporate profits. Corporations have become adroit at profit shifting, locating highly mobile, intangible assets and financing activities in low tax jurisdictions, and using transfer pricing to maximize their returns. This shrinks the corporate tax base in higher tax countries where the traditional source-based factors of tangible capital and workforce are often located. The OECD base erosion and profit shifting, or BEPS, Pillar 1 and Pillar 2 initiatives would counteract these trends in two fundamentally different ways. Pillar 1, as we've heard, would take a share of the largest multinational corporations' global book profits above a certain revenue margin and allocate it by formulary apportionment among market jurisdictions where corporate sales and or end users are located. Instead of a source-based or residence approach to taxation, Pillar 1 would thus be destination-based. Pillar 2, by contrast, would strengthen residence-based taxation by encouraging companies to adopt a global minimum tax on the foreign earnings of resident corporations. The current proposal would subject foreign earnings in excess of a percentage of foreign tangible assets and payroll, or carve-out, to a minimum tax rate, currently 15%. Jurisdictional pooling would limit the offsetting of profits, losses, and foreign tax credits to a country-by-country level. So to kick off, I've asked each panelist to prepare a 5-minute statement on their views about the most important aspects of BEPS Pillars 1 and 2 and their interaction with the US corporate tax. So we'll turn to Lily Faulhaber. Lily, please go ahead.
Great, thank you so much. So I think the first thing to point out is that this is a huge development. I don't think it can be overstated how hard it would have been to predict 5 or 10 years ago that we would be here talking about new allocation rules and a minimum tax. During the first round of BEPS from 2013 to 2015, both of these were off the table. And now the OECD has managed to get over 130 countries to agree to these. So I think the first thing to note is just how important this is and what a major development is. That said, I think that the big question now is what remains to be done to make sure that the reality of Pillar 1 and Pillar 2 live up to the aspirations and expectations that have been set. So in the next few minutes, I just want to talk about the two types of work that remain to be done. And I'm happy to talk more during the panel and during the Q&A about this. So first, there's continued technical work. And second, there are questions about the work that needs to be done for implementation in individual countries. So let me start with the technical work. So the OECD acknowledges in its July 1st statement that more work needs to be done between now and October 2021, and also that these won't go into effect until 2023. So there is sort of more time that is going to be filled with more work, and there's still a lot to do. So just a few things to highlight. So Grace mentioned in Pillar 1 that the amount allocated still needs to be determined. There are other areas of work in Pillar 1 as well. So there are sourcing rules, right? This is about destination, figuring out what the market jurisdiction is for certain types of transactions still needs to be determined. There are also the questions about segmentation, right? Is there going to be a way for certain business lines to be treated as profitable even if the company itself is not? Under Pillar 2, Grace mentioned the rate. That's obviously what's getting the most attention, but there is also work to be done on the specific rules about the effective tax rate, because if you don't all agree on what the effective tax rate is, then setting a number above which it has to be sort of doesn't tell us that much. There's also work to be done on carve-outs, and that those areas and others are going to really determine how effective these pillars are, right? If you have a huge carve-out that means that Pillar 2 doesn't actually apply to much, then Pillar 2 is less effective. So this technical work still remains to be done. The OECD is very explicit that this remains to be done, but it's worth keeping an eye on for the next several months. The next area of work is implementation. So Pillar 1 implementation, there's the question of this multilateral instrument. What will it look like, and how will countries implement this in domestic law? So there was a discussion about that, sort of, will this require a two-thirds majority in the Senate? And there will be questions sort of about how this will be implemented. Under Pillar 2, I think it's important to highlight that 132 countries have agreed to the concept of Pillar 2, but they have not agreed that they will implement Pillar 2. So I think one of the big questions here is, I guess these are two questions: who will implement Pillar 2, and what will they implement under Pillar 2? So let me start with who will implement Pillar 2. Now, one thing worth noting, and I think this gets lost in a lot of the stories about this is not a minimum tax rate, right? Countries aren't saying, I'm changing my corporate income tax to a 15% rate. They're saying, I'm imposing a rule on my subsidiaries, and I'm imposing a rule that turns off deductions for payments out of my country. And that's going to have the effect of pushing up tax rates around the world. So one of the really clever things about Pillar 2 is we don't need everybody to implement it. This should have the effect of limiting tax competition if just many of the big economies implement it, right? And that's, the US didn't want to be the only one, but we don't need 139 countries to implement it. That said, one of the issues that's going on right now that's worth thinking about is who will implement it? Will all the big economies implement it? And can they implement it? So one area where this is important is in the European Union. So 3 of the holdouts of the 139 are EU member states. And one of the big questions is, if they don't go along, can the other member states implement something like Pillar 2 themselves? So you have several member states who have been pushing for Pillar 2 for many years, but Estonia, Hungary, and Ireland are pushing back against it, probably not just at the OECD level, but at the EU level, joined by Cyprus as well. In the United States, there's the question of, can we change guilty to be fully consistent with Pillar 2? Do we have to? And does the Biden administration actually want to go further, right? The Biden administration's proposals for changing guilty are more aggressive than what's been agreed. And so how will that move forward? And that the final question here, I said that there are two questions under Pillar 2 about implementation, is what will be implemented? So Grace mentioned that there will be model legislation. Another question is monitoring. What are we going to do if different countries design their legislation slightly differently, right? If they define the effective tax rate differently, if they have separate carve-outs, what's the effect of that? So these are just some questions to think about. I think the big picture here is that this is a major development, and this was unexpected only a few years ago. And the big issue is, how can we make sure that what actually ends up being implemented is living up to the expectations that this has built. So thanks very much. I look forward to the conversation.
Thank you very much, Lily. Next, we'll move on to Li Lu.
Thanks a lot, Thornton. It's a great pleasure to be here. So first, the disclaimer: views expressed here are my personal opinions only and do not represent the official views of the IMF. So as we heard, the two-pillar solution is a giant step in the right direction of reshaping the current international tax system. So Pillar 1 overturns a century of tax practice by allowing countries to tax companies while now they have sales, not just while they're based. So this is actually the first time revenues are systematically allocated to the market side and in serious first multilateral effort. So we see that several key elements in the foundation of the current system are being modified here. The arm's length principle for transfer pricing and permanent establishment profit attribution, and the Nexus concept, as we just heard from Grace, of Article 5 of the OECD Model Treaty. So we see that there were some quite fundamental changes to the existing system as a whole. Notably, the current scope of Pillar 1 is very limited, as we know, to about 100 companies and only a small portion of the residual profits, so that in total, it would only raise no more than 0.5% of current global CIT revenue. But rather than compromises or limitations, I see these as opportunities for more to be built on this foundation in the future. So moving on to Pillar 2, it is also a welcoming step by reducing pressures from profit shifting by multinationals. Well, any country can introduce a minimum tax on its own, but if enough large countries agree to do so, then there will be no incentive for companies to put their businesses through low tax locations, at least the businesses that deriving excess profits above the carve-out. So it can reverse the trend of going territorial. So in some sense, as you mentioned, the income inclusion rule and the guilty is a step back towards worldwide. And the trend to race to the bottom in the source country, both are forms of tax competition between countries. So again, there are outstanding issues, as we heard from Lillian's observation. For example, in the list, the calculation of the effective minimum rate. And the substance carve-out elements may also incentivize the shift of real activities, say payroll and tangible assets of multinationals, to low tax locations to facilitate the continuous shifting of profits that are sheltered by the carve-out. So to some extent, it would retain part of the ongoing tax competition pressure or even compromise the revenue gain we see here. But Pillar 2 is where the money is. So large countries that are large capital exporters will benefit from Pillar 2. So in a way, the agreement could have been structured to more directly benefit low-income developing countries, for example, by giving more prominence to the inbound. Moreover, we think that there should be a simpler mechanism to determine the minimum tax for these low-income developing countries to accommodate their administration and enforcement based on, for example, turnover or tangible assets. But these are just some of the difficult, detailed, and important technical issues to be worked out and agreed upon, together with challenges in implementations, as we just heard, as each country would need to domestically and also in the case of EU regionally, to implement at its own pace and in accordance to relevant legal processes. So very busy time in the next few months and a lot to look forward. Thank you.
Thank you very much, Lee. Now we'll move on to Drew.
Thank you. And I should also disclaim that any opinions expressed are my own and not those of my firm. I'd like to take a slightly different perspective. As Thornton mentioned in her introduction, the US is right now the only country with a substantial tax on foreign earnings. We're the only country with a minimum tax on active foreign business income. And then ask the question, are further steps required in US legislation? And while corporate tax rates have come down significantly since the early 1980s, on average across the OECD, excluding the US, corporate tax revenue as a percent of GDP has actually increased. So I would not describe that as a race to the bottom. Further, a substantial portion of the reduction in corporate tax rates was likely not in response to the actions of other countries, but would have been undertaken by countries independently for reasons of efficiency. As most countries have increasingly recognized the benefits from reducing statutory tax rates and broadening the tax base. We can observe a similar decline in US individual income tax rates. In the 25 years between 1963 and 1988, the top individual tax rate in the US fell from 91% to 28%. I don't suspect this was done for reasons of global tax competition. Between 1981 and 2020, the average corporate tax rate in the OECD declined by about half, from around 50% to around 25%. The efficiency reasons for reducing corporate tax rates include reducing a number of distortions between debt and equity, between corporate investment and non-corporate investment, the allocation of capital across types of assets, the choice between productive investments and less productive non-taxable perks for employees, as well as the increasing international mobility of capital. Economists generally, and indeed the economists on the staff of the OECD, have long regarded the corporate income tax as the form of tax most harmful to economic growth. Second, we'll be discussing income shifting today, but accurate data on income shifting is of course not readily available given the difficulty of knowing where that income would have been reported in the absence of differences in tax systems. Data sources that do exist have not always been used appropriately. For example, accounting professors Jennifer Bluen and Leslie Robinson have replicated research by Kim Klossing and determined that her research has overstated income shifting from the US by tenfold. The problem identified by Bluen and Robinson is that the BEA direct investment data series used by Professor Klossing of US multinational income includes not just the income of a US-owned foreign subsidiary in a particular country, but also includes the income of all of the foreign subsidiaries owned by that foreign subsidiary. Because the top-level company of a group of foreign subsidiaries is often a holding company located in a low-tax jurisdiction, relying on this data set improperly resulted in Professor Klossing assuming that companies were reporting for tax purposes all of the income of their foreign subsidiaries, much of which was high taxed, as being earned in the low tax holding company jurisdiction. Third, with respect to the US, we know that corporate tax revenue has fallen as a share of GDP over the past 40 years. But importantly, corporate income has also fallen relative to GDP, largely due to the growth of pass-through businesses, which pay tax under the individual income tax. In 1980, pass-through businesses, including partnerships and S corporations, accounted for only 22% of business income, while by 2016, they accounted for 62%. Research by Kyle Pomerleau and Donald Schneider shows that corporate tax revenue as a percent of corporate income in the US is higher than on average across the OECD. Further, to bring this right up to the present, based on daily Treasury statements through June, it appears that US corporate income tax collections this fiscal year will be the largest in history. This coming 1 year after the start of the pandemic. In the face of these facts, an argument that the current US corporate tax system is a victim of a global race to the bottom is difficult to maintain.
Sorry, I had myself on mute there. Thank you very much, Drew. Now we'll go to a moderated Q&A for the next few minutes before shifting to an audience Q&A for the last 15 minutes of the panel. What I'll do is I'll pose general questions to a particular panel member who will be able to take the first crack at it. But if the other two panel members then would like to respond to the first panel member, feel free to do so. So Lee, first question's for you. In trying to fix the problems that source-based taxation has been creating, does it make sense to move towards both destination-based taxation, as in Pillar 1, and residence-based taxation, as in Pillar 2, at the same time? Do you see one direction as preferable to the other? And do you think that if we did both, as the BEPS pillars would do, would you expect to see one system prevail over time?
Thornton. Well, I think given all the issues that you just described in source-based taxation, both pillars are essentially focusing on tax base that are less mobile than the actual productive activity of multinationals. So one option is destination-based, which would have been the most effective way to eliminate profit shifting and tax competition, given that the location of customers and sales is clear-cut and rather immobile. So this is the direction that Pillar 1 is moving towards, though it is only partial, at least for the current state. So much of the issues actually remain. So Pillar 2 takes a different approach and strengthens residents. It is welcoming to the extent that the residence of multinationals is less mobile than the production and their book profits. But we know that residence-based tax has its own difficulties. So firms would have incentive to change their place of residence or location of headquarters, and countries would have incentives to attract corporate headquarters. So unlike destination-based, it does not really take away the innate pressure for tax competition, which is exactly why we saw countries switching to territorial over the last few decades, and would require global coordination to revert the trend. So also from the perspective of developing countries, which are nearly always primarily source countries, so allocating the entire tax base to residents of multinationals would be disadvantaged. It would also worth noting though, with the new elements of destination in Pillar 1 and residence in Pillar 2, both pillars are not so much at the expense of source. So we see that the amount B in Pillar 1 and the subject to tax rule actually strengthen source, and the extractive industries are excluded from amount A. So it is not 100% clear that the reform is shifting away from source taxation. In terms of stable equilibrium, I would rather leave it to the development of economic forces, which are actually driving the change we see today and would continue to make multinationals more mobile and innovative, shall we say. So tax competition is difficult to address under source-based taxation but also under residence. So we were likely to see a shift towards more adoption of the destination element approach. If we take a look at the overall picture of taxation as a whole, we see that there is a shift towards a greater use of consumption tax at the expense of corporate and labor taxes. So this is a pretty much indicative trend of the direction it's going. So just to quickly summarize, so first, shift to destination would make the system more robust to profit shifting and tax competition. So we would expect to see the trend in this direction. Second, strengthening residence in Pillar 2 would also help to mitigate tax competition among source countries. And last but not the least, strengthening source is also important and also part of the package, especially for developing countries. Thank you.
Thank you very much. Lily or Drew, do you have anything that you would like to add?
Can I just follow up quickly? I think one interesting thing about the sort of destination resident source interaction within Pillar 1 and Pillar 2 is that destination is the new part, right? Destination is the new part here. And I think that this is sort of a safe way for the international community to try out destination tax. And what I mean by that is we all remember the DBCFT debates, and that just felt much too dramatic, right, in the United States to sort of make this huge leap. And so now you have this amount A, which is essentially just layered on top of transfer pricing, right? It's not eliminating transfer pricing and replacing it. And so I do think one of the lessons from the original BEPS project was that a lot of outcomes from that seemed as if they didn't really have legs now have been put into law, and now are sort of acting as models for other future reform. And it will be interesting to see whether or not amount A just remains as amount A, or whether amount A actually ends up kind of opening the door a little bit to destination, because it feels like a kind of safer test case than a complete reform. So that's just something to keep an eye on.
And I guess I'd add, one of the issues has been, it seems as if the rest of the world has been more interested in Pillar 1 and less interested in Pillar 2 than the US. And Michael Devereaux has released a paper earlier this month that suggests that 60% of the income that would be reallocated under Pillar 1 is of US companies. And you might contrast that with the US comprising about 20 to 25% of world GDP. So the interest of other countries may be that this is taxing income that the US would otherwise have taxed. So perhaps not a surprise that they're interested. The interest is, why would the US necessarily go along with this unless it's sort of a quid pro quo for other countries to adopt Pillar 2 to sort of match what the US has already done in that direction.
Just a quick follow-up question there. I mean, yes, this Pillar 1 is often seen as hitting US multinationals in particular, and so undermining the US tax base. But, over the last couple of decades, it seems as though the US has not been terribly interested in taxing that income itself. I mean, a lot of it has remained offshore, and there's been use of hybrid structures. I mean, do you see an issue there? Or if any of the other panelists would, Lee, you were nodding your head.
It seems as if the BEPS, other BEPS reforms have been adopted over the past couple of years, have addressed hybrid structures. The US is taxing foreign income at a reduced rate under GILTI. Again, I don't see the benefit to the US from ceding the tax jurisdiction.
Very good. Well, the next question is for Lily. You've written a great deal about digital taxation. BEPS Pillar 1 was originally targeted at the top digital service providers, a category currently dominated by US corporations, as we've been discussing. The Biden administration has convinced the Inclusive Framework to instead target the world's largest, most profitable companies, so less hinging on the digital activity per se. However, of course, the top companies are also dominated by the US corporations. While at the same time, we would retain the Trump administration's position that countries which have enacted digital service taxes, or DSTs, should repeal them once Pillar 1 is implemented. Does Pillar 1 still address the issue of taxing digital services? And does the US requirement for DST repeal still make sense?
Well, thanks for mentioning my writing about digital taxes. And I will say my general point is that no one ever agrees on what digital taxation means, right? No one agrees on what the digital economy is, what digital companies are. So I personally feel kind of validated by this. And what I mean by that is that I actually think that the new scope of Pillar 1 is more honest about what countries have actually been worried about. What countries have been worried about is that there are big companies out there that seem like they're making a lot of money and they're not paying taxes to the countries that feel that they should have some right to that. And so by focusing the scope on that in a way that focuses not just on revenue, on just sort of overall gross revenue, but also on the specific profitability level, I think that that's at least kind of getting to the political focus of when countries say we want to be taxing the GAFAs or the FANGs or however you define the big tech companies. We really are upset that they seem to be profiting and that we, the countries, don't seem to be benefiting. Now, this will still end up being big tech companies, a lot of them in the United States, but I do think it sort of acknowledges that it's less about the specific business models. It's less about the fact that they're engaged in tech, however you define that. And it's more that they seem to be making a lot of money, and they seem to be making a lot of money off the consumers in countries where they don't have a physical presence. In terms of getting rid of the DSTs, the United States has been pretty consistent about that across administrations. And my sense is that that was kind of a red line that the US wasn't going to cross, right? They weren't going to let DSTs remain if they were going to sign on to Pillar 1. And so it seems unsurprising that they are requiring DSTs to be eliminated. The one outstanding question up until a few days ago was, what did that mean for the EU Digital Levy? It seems as if Treasury Secretary Yellen has convinced the European Union that they should at least put that on pause. They did all agree to that a year ago and put that into their budget, and so they'll have to figure out sort of how to raise that money without that if they don't keep that. But it seems as if that was sort of a point of contention that's at least been pushed down the road.
Very good. Lee or Drew, would you care to add anything? Okay, so we'll move on to the next question, which is about Pillar 2. This is for you, Drew. The recent OECD agreement states that consideration will be given to the conditions under which US GILTI regime will coexist with the GLOBE rules to ensure a level playing field. Could you outline the major differences between the Pillar 2 proposal and both the current GILTI regime and the reform of the GILTI regime that have been proposed by the Biden administration? And what concerns do they raise about fair competition across countries?
Thanks, Darden. Last October, when the OECD released its blueprint on Pillar 2, the OECD noted that the US GILTI rules were tougher than the Pillar 2 model in a number of respects. And I identify 6 major differences between the Pillar 2 blueprint at that time and the US enacted GILTI rules. And 5 of them are differences where the GILTI rule is tougher, more restrictive, raises more revenue, and 1 is looser. I'd start with first, the GILTI computation is based on a single year snapshot of income with no carry forwards or carrybacks, no adjustment for timing differences, whereas the Pillar 2 blueprint has those features. You can carry forward losses from a prior year, you can carry forward taxes in excess of the minimum amount, and it envisions certain adjustments for timing differences between financial statement reporting and local tax law. And that's really important. If you think of a company, a startup company, it might have losses in the first year it's operating abroad. In the second year, under local tax laws, it will be carrying forward those losses, not have to pay tax. What GILTI does is it looks at year 2 income on a standalone basis without recognizing that you're not paying taxes in year 2 because you're using losses from a prior year. So that's a very important feature. Now, what GILTI does, which is more generous than Pillar 2, is right now it allows averaging of taxes across countries. You look at all of the foreign countries as if they're a single unit, whereas Pillar 2 envisions a country by country determination of minimum tax liability. And so what you can sort of view Pillar 2 doing is allowing averaging over time, but not across countries. US GILTI doesn't allow averaging over time, but as sort of a remedy for that, allows the averaging across countries under the assumption that some of those timing differences will average out over countries. The Biden proposals, the major change is they propose GILTI be calculated on a per country basis, but they haven't proposed those reforms for the timing adjustments. So you can get a very inaccurate measure of the true income of a company over time. A 1-year accounting period is a very arbitrary period without those loss carry forwards accounting for excess taxes and so forth. So in the year a company has a loss, it won't pay a minimum tax, but the next year it will when it's using that loss or that timing difference. The Biden administration has also proposed repealing what's called the QBI deduction, a deduction for a return on tangible investments, tangible property. Pillar 2 has a broader definition of tangible property, including land, for example. And Pillar 2 also includes allowing a return on your workforce, on the payroll. So Pillar 2 has a broader substance-based exemption than GILTI, and the Biden administration is proposing we have even a narrower one, none, no substance-based carve-out under GILTI. So again, that's going in an opposite direction. Pillar 2 operates as a pure top-up tax. Right now, the discussion is around a 15% minimum tax. So if you're paying less than 15% in a particular country, you'll be grossed up to 15. GILTI operates somewhat differently. All GILTI is included in taxable income of a company, but companies are then provided a 50% deduction, which is intended to roughly tax that GILTI at half the statutory rate. There are interactions, there's a limitation on how large that 50% deduction can be. And so, for example, if a company has domestic losses, but it's including GILTI income, that GILTI income is offsetting the domestic losses dollar for dollar. So essentially, that GILTI income is effectively being taxed at the full statutory rate. In addition, one of the differences between this top-up tax and GILTI allows only an 80% credit for foreign taxes, whereas the top-up tax is effectively 100% credit. As a result, GILTI is always paid right now until the foreign rate exceeds 13 1/8. After 2025, under present law, it would be until the foreign rate exceeds 16.4%. The Biden administration has proposed effectively changing that to 26.25%. So significantly greater than the proposed Pillar 2 rate for the rest of the world. And just as an example of how much more dramatic that is, let's assume a company had operations in Ireland and the effective tax rate was 12.5% in Ireland. Under the Pillar 2 15% rate, if it was a foreign company, it would owe a top-up tax of 2.5%. Under President Biden's proposal in the US, it would owe a GILTI tax of 11%. So a significantly greater differential. And the concern there is that US companies, their foreign operations would be at a competitive disadvantage, even if the rest of the world adopted Pillar 2 as it's presently being proposed. And there's a final difference. We've often heard problems of expense allocation with GILTI due to the foreign tax credit rules that were inherited when GILTI was enacted. It turns out even when companies have average foreign tax rates in excess of the rates I've been suggesting, 13 1/8 under current law, companies can still owe GILTI. And so even under President Biden's proposal, GILTI may be owed even when the foreign rate is in excess of 26.25%. So again, I think US companies want a level playing field on their foreign operations. If the rest of the world can adopt something like the Pillar 2 proposal, then it might be appropriate for the US to align its GILTI rules with Pillar 2, but not to move first and further harm the competitive playing field for US companies.
Thank you very much. Other panelists, anything that you'd like to add? So we're kind of segging into the audience-based Q&A. There are several questions relating specifically to developing countries. So Lee, given that you're at the IMF, this one's for you. Can you talk a bit about how Pillars 1 and 2 would affect the allocation of global corporate revenues, specifically, developing countries fare as a result? And if I understand correctly, developing countries, some of the countries that have reneged from signing the July 1 agreement are in fact low tax European countries, but there are also several high tax developing countries that did not wish to sign on to it. So could you talk a bit about, what developing countries, what changes they would like to see in the agreements that are emerging from the BEPS process and why?
Sure, thanks a lot, Thornton, and thanks a lot for the questions. So I think I'll basically discuss based on how the developing countries would be impacted in terms of their revenue, just to answer these questions. But the caveat is that a lot of technical details are still being worked out for both pillars. So the revenue impact that we talk about for developing countries and for country groups as a whole is more about changes in direction rather than the precise magnitude. So that's the caveat. So I think perhaps the most important thing to note is that Pillar 2 actually has a much larger revenue potential than Pillar 1. So based on the OECD's number, the total revenue from Pillar 2 with a 15% minimum tax is about 150 billion, and is more than 10 times the amount of revenue from Pillar 1. So this alone would suggest that if many large countries move to residence-based tax, then more revenue would go to these countries that are large capital exporters, including the US. But the design matters a lot, both for Pillar 1 and for Pillar 2, and also how the multinationals would respond. So for example, the substance-based carve-out, which is based on payroll and tangible assets, would mean only excess profit would be covered by the minimum tax. So the carve-out alone can reduce the potential revenue by half. It can also exacerbate shifting of real activities to facilitate profit shifting and therefore compromise some revenue. So for low tax countries that you just mentioned, they will have a strong incentive to raise their tax up to the minimum if the tax rate is primarily serves as incentive for profit shifting. So if so, the revenue for residence country would be reduced. But whether this revenue would go to the formerly low tax countries would depend, of course, on how the multinationals would respond in terms of their investment flows. So for developing countries, because the rule order, they may not gain much from the undertax payment rule, because the income inclusion rule take precedence of the undertax payment rule, and the subject to tax rule may also bring in very little. So the main benefits for developing countries would then come from the reduced pressure for tax competition, including through tax incentives, which is still a big deal for these countries. For Pillar 2, sorry. So now for Pillar 1, the updated Pillar 1 version involves a much smaller number of multinationals that are resident in no more than 25 countries based on some of our own estimates. So residual profits are still remain concentrated in those headquartered in the US, more than 60% of global residual, followed by China. So in terms of the sector, tech companies would account for about 45% of residual profit, followed by pharmaceutical companies. So when it comes to Pillar 1 and how developing countries would be affected in terms of their revenue, there were three main elements. So first is the new taxing right, which would benefit many countries, including developing countries, because based on our own research, many of them are also destination countries. But this would come at the expense of residence country, because these are the country group that would give either exemption or tax credit for this profit, especially the US. And also the rollback of DST would mainly benefit the US digital companies, but not so much the government. So that's basically how the developing countries would be affected in terms of their revenue under sort of the overall big picture of how global revenue would be affected by both Pillar 1 and Pillar 2.
Thank you. Thank you very much. We've had several questions relating to Pillar 1 as a tax on global book income. As the panelists have commented, Pillar 1 is sort of the most innovative aspect of the BEPS program. And so this question is for you, Drew. How would shifting towards a tax on global book income impact corporates' ability to how would curbing their ability to shift income to low tax jurisdiction and tax their consolidated book income, how would that affect their behavior, in particular investment and financing? The curbing the shift to curbing the ability to profit shift, of course, refers mostly to Pillar 2, but also the tax on book income. How would you expect that to affect corporate behavior?
Yeah, I think, again, Pillar 2 is the more important element there. And from a US perspective, I think US companies would welcome other countries adopting Pillar 2 because it would provide a more level playing field for US companies, which currently already are operating under a minimum tax. There have been some great statements by countries coming out of the G20 meetings. The real question will be, will we see legislative action by those countries? What will it take for them to actually enact and implement those minimum taxes? As we know, the US adopted a minimum tax almost 4 years ago now, and no other country has tried to do anything similar since then. they don't need to wait for other action. But you know, the real test moving this out of the hypothetical is, will the other G7 countries move forward and enact it? Are they going to wait until they see the US try to change GILTI to per country, or move forward on Pillar 1? Secretary Yellen has indicated that Pillar 1 is on a slower track. There's a lot of belief that adoption of Pillar 1 by the US would require essentially new treaties, which then require a 2/3 vote in the Senate. And in our closely divided Senate now, that is an extreme hurdle. So it will be, you know, interesting what confidence other countries have if they need to wait for US action on Pillar 1 before adopting Pillar 2.
Very good. Thank you. So turning then to the issue of implementation. Pillar 2 has the status of a common practice, so it does not, as several people have commented, it does not require unanimous adoption. Whereas Pillar 1, which does require unanimous adoption in order to get through. Lily, I was wondering if you could comment on what you see as the greatest challenges to implementation, particularly in the US. Grace was talking more about implementation at the global level, and particularly to ratification of Pillar 1.
Oh, to ratification of Pillar 1, not to Pillar 2?
Well, both.
Okay.
But yeah.
So
Pillar 1 can't go ahead without US approval, whereas,
yep.
Yeah.
So, you know, first of all, I think the technical details that still remain actually will play into implementation, right? Countries are still negotiating what they think they agreed to. And so I actually do think that even though I broke apart technical details and implementation, I think what countries are willing to implement is going to depend on what they're willing to agree to and what kind of compromises they can get from other countries over the next few months. In terms of implementation, I mean, implementation is going to be hard for the United States for Pillar 1, right? I think that that's why Yellen has come out and said this is going to be slower. I mean, the members of Congress have already said that they're concerned about this, that they don't want US companies being subject to extra taxation. I think the fact that it's essentially what we did in order to get to eliminate DSTs is maybe going to be helpful, but I think Pillar 2 is maybe going to be easier to get through, partially because, you know, as Drew has said, and as Grace mentioned, and as we've discussed, we already have a version of Pillar 2 on the books. It's different, but there's something there that members of Congress agreed to several years ago, and often those are the same members of Congress who are sort of expressing opposition to it right now. But on Pillar 1, I think that to the extent that there needs to be 2/3 support, you know, when I talk to international groups, and I'm sure there are participants on this right now who have thoughts about this, I hear about how there are lots of treaties that are backlogged in the Senate for years, right? So I think that actually this is something that we have to keep our eyes on. As I've said, you know, the international tax world kind of surprises me in a positive way a lot, that more things get done than we necessarily expect. But this does seem like this is an uphill battle still.
We've had several questions relating to Pillar 2 and the calculation of the effective tax rate. And how if Pillar 2, of course, the current blueprint is for jurisdictional pooling or a country by country basis. How feasible is calculation of a country by country effective tax rate, particularly for lower income countries with less developmental capacity. Lee, you were nodding your head. Maybe you could
take the first crack. Okay, yeah. So I think, as Grace mentioned, all of this calculation needs to be based on information that is publicly available, which leads to the country by country report. So I would bet that the calculation of effective tax rate would also rely on information on the country by country report, pending a few adjustments, which are still sort of to be worked out. That to be said, it does hinge on the capacity and administration capacity of countries. So when it comes to low income country, we see that there are simpler alternatives that would sort of simplify the calculation of the effective tax rate. And I guess that's why we've been sort of advocating or emphasizing that given there are complications and complex rules to follow for the calculation of effective minimum tax, there can be sort of simpler alternatives, say based on sort of a preset fixed percentage of turnover or prefixed percentage of tangible asset that can be the equivalent of the effective tax rate that's set in Pillar 2.
Thank you. Drew or Lily, any comments on the feasibility of the functionality of effective tax rates? Or we also have a question relating to how they should be calculated on a cash or a broader basis.
I guess my main thought is Grace mentioned model legislation, and I think the more detailed model legislation can be, and if there's some flexibility that some countries can adopt this type of calculation, other countries can end up adopting a different one, or you can adopt a different one sort of as you get used to having a law, that will be helpful. I think that the hurdle to having really detailed model legislation is it prevents countries from thinking they agreed to something, but not actually, but hiding the fact that there's disagreement. So the more detailed the model legislation can be, the easier it is to adopt into countries' law, and the easier it is to sort of clarify that everyone agrees on this. I think that's true for effective tax rate as well as other areas.
Yeah, and I would just, again, reemphasize the arbitrariness of a single year accounting period to measure a tax. So it'll be really important that there are carry forwards of excess taxes and crediting for minimum tax paid and accounting for losses occurred in a prior period. So that may require more complexity than the current country by country reports include.
Great, thank you. Just one quick question to conclude. I've been astonished when I look at the list of inclusive framework countries at the number of low tax jurisdictions that are participating in the BEPS process. Makes sense that they would want to have a seat at the table. But as Grace has described, if Pillar 2 is implemented by a substantial number of capital exporting countries, a country by country foreign minimum tax would really down the business models of many low tax jurisdictions. So I was wondering if any of the panel members could comment on sort of the incentive compatibility of participation in the inclusive framework particularly for low tax jurisdictions, but also for capital exporters acting unilaterally. Capital exporters have been trending towards source-based taxation and exemption of foreign earnings. How is Pillar 2 in particular incentive compatible?
So can I follow up on this quickly? So I'll focus just on the low tax jurisdictions. So I think there are 2 points, and one of them actually is something that's been going on at the OECD that I think hasn't gotten much attention. So the first point is there's some degree to which low tax jurisdictions wanted to be at the table, and they knew that this could pass and this could be effective without them, right? So if several large economies end up having minimum taxes, that will end up having pushing low tax jurisdictions away from having low tax rates. But the second thing that I think is important is that over the last several years, the OECD has been pushing low or no tax rate jurisdictions to have substance. So this has been happening in the context of Action 5. There have been some publications that the OECD has issued about this. So one thing to keep in mind is when we look at the substance-based carve-out, is that requiring the same things that these countries have already agreed to have? And if so, does that actually mean that these low tax jurisdictions will have all the income that falls into that substance-based carve-out not subject to the minimum tax? And if that's the case, then that's actually something really important about the substance-based carve-out.
Yeah, and I guess.
Well, I apologize for raising such a big question right at the end of the. I have a habit of doing this, but unfortunately we are out of time, and I just want to thank all the panelists and Grace and Tracy, all for a really informative event, and thank our audience members for their questions.
Thank you.